Okay, good afternoon. Time is short, so we might as well get started. For any of you who don't know me, my name is Danielle Park. I'm a portfolio manager and president with Venable Park Investment Council, and otherwise known as the proprietor and author behind the financial blog jugglingdynamite.com. But most of all, I am a humble financial analyst, and no, that's not an oxymoron. There are a handful of us in the world. Now, only fools and liars pretend to predict the movements of the stock market with precision, and certainly when that comes to price. People who will assure you that they know exactly what's going to happen with price in the next few weeks or months are blowing a lot of hot air. So I am not aspiring to do any of that here today. But as someone who's been trained to take measurements, risk measurements of capital markets, and who's been doing that now for nearly 20 years, I'm here to tell you that the measurements that we can take that are historically reliable are telling us that risk in capital markets today is as high as it has been pretty much in history. Certainly as high as we measured it to be in 2007 and 2000, and at every other epic market top in human history. So the presentation that I want to go through in the next 30 minutes will give you some insight into some of the more cogent indicators that I am pointing to in support of that thesis. First of all, I would like to reiterate that the most prevalent theme today that has become common knowledge and consensus view is that the Federal Reserve is printing money and that this is supporting stock prices, and since they will not stop in the foreseeable future, stock prices will continue to go from here to the planet Venus. Now, let me tell you that humble study of history will tell you every euphoric blow-up top in every market cycle has come from a similarly erroneous and widely held belief. We had the belief in the late 90s that the internet had changed the world and that the business cycle no longer had to have contractions in it. We had the similar erroneous belief in the 06-07 cycle that commodities were going to be in high demand forevermore because emerging markets in Asia was needing to build things. Now, both of those were wrong. Both of those marked an opportunity to lose half of invested capital. And I'm suggesting that this new belief system is likely to be just as flawed. The other thing that happens when a market has gone up, as it has for the last now 4.5 years, is that people who are the least careful and the least insightful about what they're doing, the most reckless, the most exposed to the price cycle, begin to appear like the wisest and the smartest and the people who really know what they're doing. And I would warn you that we are there again today. So there is no question that the QE cycle, the injection of capital into world markets, has supported a belief that the Federal Reserve would have its way, that stock prices could only go up. And because of that belief, it definitely has had an impact on price, I would suggest. But that belief, being a superstition and not a truth, is likely to be shaky at best. The other thing that is widely missed in this whole assessment is typically the fact that the biggest thing that happened out of the bottom of 2009 was that the FASB accounting rules were set aside, so that no longer did financial institutions have to accurately disclose the fair market value of the assets on their balance sheet. And this, ladies and gentlemen, has been the greatest reason for the turnaround out of 2009. And might I tell you, they have still not brought back that rule. So anyone who is poring over financial statements today, especially of financial institutions, and professes to have a good handle on the strength of the company, is living in a fool's paradise because they don't actually have any disclosure or insight. The truth of the matter is that the logic behind QE was that by injecting capital into capital markets, in repos with the bank, that they would engender animal spirits, which would make people feel wealthier, which would trickle down into investment in the economy, people borrowing from banks, creating jobs, and going back on the merry way of recovery. Sadly, that has been farther from the truth. Indeed, at Jackson Hole this summer in August, the Federal Reserve members themselves presented several papers that definitively concluded that what they had hoped QE would accomplish has been a miserable failure. So although they have managed to, as I've said, stimulate superstition that asset prices can only go up once more, what they've accomplished is in fact to quadruple the balance sheet of the Federal Reserve and to achieve half of the historic growth rate in the economy. The trickle-down effect, the money multiplier, has been almost nil in this process. The Federal Reserve throughout, however, has continued to forecast much more robust growth any quarter now, quarter after quarter. The Bank of Canada was following suit as well. It was just this week that they capitulated and said, okay, growth is a lot worse than we had hoped. So this is a very common tactic that central bankers follow. They are the confidence men and women. Their job is to try and lead people towards belief in the economy and in growth. But unfortunately, once the doubters realize that that is just belief and nothing further, there's always a period where they fall out of favor. And I'd suggest we're getting to that period right now. So the thing that makes this more difficult than any other period we've seen in history, as the prior chart showed you, we in fact have half the growth rate and the lowest economic growth in the US that we had since 1930. Now, everyone knows 1930 was the period, the 30s was the period of the Great Depression, but we actually have that decade's growth rate today. What's different this time, and this chart shows it, is that we actually have more debt in the world today, and certainly in the US, and certainly in Canada and Europe, most countries, than we did in the 1930s. And this matters for two reasons. Because there is much less budget, much less buffer, much less money available to try stimulative actions into the real economy. Once we get past the sideshow of QE, the actual infrastructure investment that is needed in the world today is huge. And the capital available is limited because of the actions of the last number of years. So that is a bit of a headwind in terms of how quickly we can reinflate our way out of this particular sluggish period. Because the fact is that the weak demand in the world has been a vicious cycle. Coming out of the consumer credit bubble peak in 2007, people have more debt, the least savings they've had in decades, and they have very little ability to consume at the rate they were doing prior to the burst. So we've had weak demand. So companies running business models in the real economy see that weak demand and say, there's no reason for us to build that infrastructure. There's no reason for us to add a whole bunch of people. In fact, we have to cut costs. We have to bring down expenses to try and grow earnings. And that's what they've been doing. So you see that corporate profits have been never higher, ever in human history. It's a remarkable feat. Very weak sales growth and remarkably high profits. But I tell you, this is the most mean reverting series of data ever known. Every recessionary period precedes a great galloping recovery in profits because companies have rationalized and downsized expenses in the downturn. So there's always a period afterwards where they're lean and mean, so any demand trickles down quickly to increased profits. But it always runs a cycle, typically 4 to 5 years, and then earnings growth can only continue with an increase in sales or revenue increases. So we've had this period where corporate profits have been the best ever, and that chart certainly shows that since 1945. But there's been a couple of accounting gimmicks going on, not just the setting aside of fair disclosure rules on balance sheets, but there's been a bunch of borrowing money at cheap rates to buy back shares because that will artificially or in the short run, it supports greater earnings per share. Less shares going around to take credit for the earnings, you get a higher earnings per share. The problem is that this is precisely the short-termism that has got us into this mess in the first place. The likes of Carl Icahn and company who are pushing companies to divest themselves of cash that they've built in their war chest, he's not pushing them to invest in research and development. He's not pushing them to recreate some of our infrastructure and be brilliant in the ways that would transform the economy. He's pushing them to give him back cash. So this kind of investment is exactly the antithesis of how we can grow the world back to a sustainable path. Extractive mentalities are all about taking out cash now and leaving nothing for the future. And that will be the actual bane of progress for companies going forward. And the other problem is that when we come to the next economic downturn, which I'm about to show you, I think we are coming to in the very near term, companies will then have less buffer. The problem with debt is it is future consumption denied. So we learned this from the consumer credit bubble, where everyone bought big houses, furniture, cars, everything on credit. And what follows after that is a period of a hole in demand, because you've already bought your car on 7 years leases. You've already bought your appliances on don't pay for 10 years. You're not going to go and buy more until that's extinguished. And so as a result, there's less demand to go around. The same thing is going to happen with companies. Yes, they've borrowed at low rates, but they've been pushing it back to shareholders and doing non-productive things like buying back their own shares. Totally not the right mindset for long-term growth. This is just another chart to give a sample of what I'm talking about. The sales per share are at historic lows, and yet we've seen this big spike in earnings per share. In fact, the price to revenue ratio for the S&P 500 is today twice the historic average. In other words, they're paying twice as much for earnings that used to be of this size. So price matters. How much you pay to invest in something is critical to long-term success. Again, this just gives us a sense over the last 12 months as the S&P has literally gone parabolic. You see that the earnings per share trend, even with all the buybacks, even with all the balance sheet shenanigans, creative accounting, has been going down as the S&P has been going straight up. And now on every metric that we can measure, it is coming in expensive. I know many people will tell you that's not the case. And the other thing is that even though we've had these incredibly good earnings profit margins, even assuming a perpetual continuation of that trend, which would be totally abnormal historically, I still find that earnings are coming in weak compared to expectations today. The reason is that the analyst community, my cohort, like to take a chart of earnings that have been going straight up for the last 4 years, take out a ruler and draw it straight up some more. They never want to acknowledge there's a business cycle or that demand is mean reverting. It's just not in their DNA. So they're expecting double-digit growth for 2014 in earnings, even though for the last 2 quarters, companies have been disappointing lowered expectations on earnings as well as on revenue. In fact, if you take out the financials from the S&P, which are now 20% of the earnings profile of the S&P 500 companies, if you back them out, everybody else actually has reported negative earnings growth for Q2 and Q3. It's a point that's very little mentioned on the business television shows. So this is just the blue lines on the far right of the chart there are to show you that they're forecasting this big ramp up in earnings from here, and the yellow lines is the sales and revenue numbers. So there's only 2 ways that profits can actually grow at a company, and anybody that's actually managed a business in the real world will know this. You can either increase your revenue and sales, or you can lower your costs. It's the only way to make higher profits. So after 4 years of rationalizing, actually 5 years of rationalizing costs, downsizing, cutting, and buying back your own shares to support your earnings, I have a very hard time seeing how there's going to be many more years of that same approach. And so now we have to look to revenue and say, well, maybe they're pessimistic on revenue. Maybe we're going to see a pickup in demand and sales, the one that's been promised by the Federal Reserve and central bankers every day now. The only problem with that is that nominal GDP growth is what drives revenue growth in the world. So this is the collective demand of humans on the planet buying things, consuming things. What is GDP after all? It's government spending, it's investment from companies, it's consumer demand plus net exports. So we know that the governments in the world are all in austere mode. We know that even the debacle in the United States right now, where they shut down the government, the net effect is going to be some cuts to government spending, small as they may be. There's going to be some steps towards austerity. And we're seeing that in every government around the world. We're seeing that in the federal government in Canada, for sure. And so the G part of that equation is in decline. We know that business investment has never been lower. Businesses today are still sitting on cash and doing battle with aggressive shareholders, but they're not deploying it back into the real economy with any significant rate. So that part is missing from the puzzle. And then we have the consumers, which I'll look at with you in a couple of moments. So basically, when we track nominal GDP growth, it's been declining now for the last couple of years. And every other period in history when it's gone below 3.7%, you're actually already in a US recession. And it has been now below that threshold for the last couple of quarters. So just another cautionary tale on the idea of sales growth in the next couple of quarters. Again, real final sales, that's GDP minus what you've got built up in inventory, is also indicating a recessionary 1.6% at this point. Anything below 2% on that equation typically has indicated recession of growth. So we're there again and have been for the past couple of quarters. Retail sales, that infamous driver of 70% of US GDP, the consumer, they have not been shopping with the same fever that they were in the consumer credit bubble for good reasons. One of them being that they simply don't have the income level to do it. They don't have the employment level. They don't have the savings. They have still very high debt. And it's not just in America. It's not just in North America. It's in the entire world. The beauty of the credit bubble, when it was going up, was that it was a global phenomenon, right? It incented people all over the world to spend money they didn't have, to lever off real estate in pretty much every country on the planet. But the downside of that is that we are very coupled in the downturn that follows the bubble. So everyone is trying to sell their exports to everyone else. And it's not working very well. There's always disappointment, whether it's Chinese export numbers or US export numbers, or in Europe, for sure, the last few years, there's not enough customers. That is the problem. Sales is the problem. So world GDP that was above 5% growth in the peak of the consumer credit bubble is today below 3%. Now, don't worry, the optimists will tell you that's rebounding any moment now. Basically, US stocks have been an anomaly. The US market is shown there on the top, and the Indian index as well. And everything else, July of 2011, has been sideways or down. I would suggest to you this is a less manipulative portrait of what world demand picture is actually looking like. So in other words, stocks are supposed to be a leading indicator of the business cycle, and I would suggest that many markets in the world have been trying to act that way, notwithstanding wave after wave after wave of intervention. So when you see that these indexes are deflating since July 2011, that also lines up with all the other metrics we can take, consumer demand, revenue, downturn. So it suggests that the most expensive markets in the world today are definitely the US and possibly India at this point. So one of the things that happened in this grand experiment when the Fed was talking about, with great confidence, 100% confidence, Mr. Bernanke said. He has 100% confidence that his monetary experiment can be eased out at the command of his pen. The problem with it is that every single time he announced a QE, supposedly to keep rates low and supposedly to help people consume, the opposite happened. The bond market sold off with every single QE that he brought out. Rates went up. And we saw that with spades in the spring, several months ago, when he started talking about tapering, right, with his confidence that he was going to start slowing the pace of large asset purchases. What happened was the bond market went crazy, sold off fast, because it's been the benefactor of much of this inflow. And so what happened was you had an 80% tightening. Whether he says it's tightening or not, the reality is it was an 80% tightening in mortgage rates in the United States. So it is not surprising that the housing market has gone on the back burner again in the past few months. It was a very frothy, speculative little market the last couple of years, especially in the United States and Canada. And it's not surprising that this backup in mortgage rates had this effect. So every time he goes to mention that he wants to do something with his magic wand, you hear this, you see a big spike in rates, the opposite of what they're trying to accomplish according to them. So that's a problem, and it suggests that the global bond market and interest rates agree with the thesis that sales are low, revenue is declining, and the world is more likely recessing now than expanding. That's a deflationary impact. This just shows the impact of all this gutting out of savings, all this incenting people to be speculative, risk-taking, spend today, why wait for tomorrow. The net effect is they've driven people's savings into the mud. They have less resilience in households than pretty much the last 60 years. Now, the financial business likes to see everyone's savings as fresh meat for the ripping. But the fact is that very few people have savings today to speak of. And so the people that are participating in financial markets are much more fringe this time than in past bull cycles. You have a bunch of people on proprietary desks at banks trading on leverage, and I'm going to show you some more on that in a second. And what they've really orchestrated here is the third spectacular blow-off in the secular bear that began from the tech bubble blow-off in 2000. This is what the policies of trying to promote consumption at all cost have bought us. A stock market that is priced to deliver as anemic returns over the next decade from here as it has over the last decade. Tons of risk, tons of volatility, very little return. Now this just goes to show you, I got a kick out of Alan Greenspan on the news this week with his new book out, 87, still trying to repair and amend, explain why it wasn't his fault, why he couldn't have known. I was a 20-something student reading books from the 20s and 30s, and I was able to glean that human behavior is a huge factor in the stock market. But he just got it last week, apparently. And I'm not even that bright. I'm just saying it's pretty obvious. Now, this is just an example of, he was saying, you know, on CNBC, he's worried about the bond market. This is typical of stock guys. They worry about the bond market's excess, but they're not worried about the stock market's excess. His epiphany was that bubble prices with leverage create crisis. And I said, well, it's a very good job we don't have a lot of leverage in the world today then. Because that red line at the top is the amount of margin debt that's being employed right now. And that blue line on the bottom is the real return of the S&P 500 over the last 15 years. So this is why we are still in a secular bear market. We have not achieved real gains in stocks since the beginning of that chart. And the margin today is as high as it was in 2007 and 2000. And the peak in margin debt in those cycles came within 3 months of the stock market top both times. Might be different this time, just a thought. Commodities have not bought the inflationary story. They too have confirmed the deflationary impacts of this post-credit bubble downturn. Now, I was here in 2011, and I remember being in a panel of people who were asked to give their best commodities pick. And I picked the bond fund because even though commodities rebound off the bottom in 2009, it made no sense that they were priced where they were in 2011. In fact, we know now it was the echo from the bubble that first burst in 2008, came back with QE hype and hope, maybe they'll work, maybe it'll work, it's never been tried, we'll see. It gave the benefit of the doubt to the Federal Reserves of the world. But since then, commodities have voted deflation. They voted yes, all those people in emerging markets are still there, but inventories are huge, demand is weak, and supply is over what we need at the moment. It'll take a while to work that through. So again, I suggest to you that this portrait of commodity prices coming down from the peak in 2008 and 2011 confirms this idea of deflation, not a return to rapid growth anytime soon. And actually, that's positive. Because the cure to this cycle is to have lower prices so that people can afford to buy things, so that investment makes sense, And we get ourselves off of this speculative mentality where everyone's throwing cash at things, not because it makes any sense, because it might go up. The other thing that people have got wrong for the last few years is the US dollar. The US dollar index, this chart, the basket of world currencies. When the US dollar was bottoming back in 2007, people, again, got out the ruler and drew it straight down. And in our humble analysis of many years of this data, we simply said, typically currency cycles complete after about 7 years. Typically they take 3 years to bottom in a major index, and then typically they break out just as everyone is expecting them to go to zero. So the jury is still out, but the US dollar has been attracting great inflows of capital in the world. And I'd suggest that may indeed continue given the backdrop globally that I'm describing for you today. And if that does, it will continue to be a negative for commodity prices in the short run, and it'll continue to be a headwind for those record profits expected of S&P 500 companies. The weak currency was a boon to their sales, even as weak as they were. So a stronger dollar is a problem for keeping up the expectations that have been built in. And Canada has been the greatest disappointment. Canada has been, came out of the last crisis with stars and everyone thinking they were the best and the brightest. In fact, since then, our economic data has continued to disappoint. Again, if you look at the commodities chart that I showed you, that is Canada's economy. That is what's happened. And people will say, yeah, but we're a lot more than commodities. I have another chart I want to show you about that. The thing that worries me about Canada right now is that people are full of false ideas about how strong we are. The US has total debt still of about 350% GDP of their GDP. Canada has about the same. Yes, we have lower federal debt, but the federal government has downsized all of that onto the provinces. And consumers are the most indebted we've seen in decades and decades. So people have little savings here, they have overconfidence in their housing prices, and I think that we're, as I say, in the down cycle for a little bit. So again, back to Danielle, we're a lot more than commodity prices. Well, this is the actual sectors of the TSX. And I suggest to you that financial services and real estate are actually derivative sectors off the real economy. They're a service provider. Lawyers, I was a lawyer in my former life. They need to have companies doing business to have legal work. So you're seeing a lot of downsizing in massive law firms all across the country who were in the bubble, in the commodities run, in the derivatives run up to 2008, had lots of legal work. But since then have been downsizing and downsizing. So the remaining sectors on the far top of that chart, the only things that have kept the TSX at the level it is today, which is still, by the way, considerably lower than it was at the 2008 peak and significantly lower than it was at the 2011 rebound. The only thing that's kept it at this level are these interest-paying stocks. This is where the greatest price risk is today. People have gone there thinking that banks are blue chip, utilities, dividend paying, get the income while rates are low, and that is where they are likely to lose huge chunks of their capital. The investment advising community has herded everybody into these products because they desperately need to show them some kind of progress and gain. But I'd suggest to you that the really smartest thing to do would be to consider your price, risk, and exposure right now. Because the gap between the TSX, which is the top blue line, and the venture capital exchange, which is the driving bus of our actual economy, it has now come back to test its 2009 bottom. It has confirmed the thesis I'm talking about, the commodity cycle ending and the deflationary impacts thereafter. The venture exchange reflects that. The TSX is trying to resist the siren song of the business cycle. And I'd suggest to you that once the QE is revealed as a fraud and people realize how much they've overpaid for assets, the leverage will start to go the other way. And people who are sitting there collecting dividends could be very hurt. And I would like them to think about that now, before the damage starts. Don't do what everyone else does, which is in the bottom of 02, 03, in the bottom of 08, 09, make changes to your portfolio and feel traumatized for a couple of years after that. You don't have to stay on a crazy bus. You are able to step off. You can wait to the sidelines, because even if we weren't in this extreme condition, we are due for the next global recession. It's just part of the way the business cycle works. It's not the end of the world. It's actually healthy. Lower prices will be good. They will help us. But we have to first get through the downside and not lose money again. So don't expect interest sensitives to decouple. Please know that price risk is very high right now. Look at your portfolio and try and make adjustments before the next wave of a bear comes. And just think of value over growth. Thank you very much.